Hey guys, Cameron here with Emerson Property Management. Every week I bring you tools, tactics, strategies, lessons I've learned, things that helped me build up a sizable portfolio in about 2 years and now manage that portfolio. Today, guys, you might notice I look a little different here, rocking the stash, pulling the, what do they say? The Reno 911 look, I think. Don't want to see my shorts. So today I want to talk about this single family inventory issue that we're having here. I say issue. I'm going to talk specifically about the Houston market. So if y'all are in another area, it might be different. I just want to talk in general about Houston, what we're seeing. So I've done a video recently about the rise of Reynolds in the market and how we're adjusting our strategy and what we're doing to adjust our strategy so that for really anybody can do it, but this is really what we're doing aggressively with our owners to make sure the properties get filled. So if you haven't checked that out, check it up here, link to it. But the other thing I want to talk about is we're seeing a rise in inventory of properties of single family rentals. And then we're seeing that rise of the single family rental price. So most people are buying a single family property to generate long-term wealth. I've said it once, I've probably said it 1,000 times now, but I used to be a big believer in cash flow. Like that was why I was buying them. I wanted to get out of my job. I want them for cash flow. But now we're seeing rates go up prices, that is, values go up so fast over the past couple of years. At the time of this recording, this is September 2022. So COVID time pushed property values up in the Houston area 10 to 20%, depending upon where you were year over year. And so now we have this little bit of cash flow, a couple $100, $200, $300, $400, $500 on this massive block of maybe 100, 200,000 in equity. I mean that, when you're making $4,000 or $5,000 a year on 100,000 or 150,000 in equity, it really doesn't make sense. So that's one thing I want y'all to be aware of in your portfolio. One thing I want to talk about. So if your property has gone up in crazy appreciation, you've just seen the values rise up and your rents have kind of stayed, down or maybe haven't gone up as quickly. This might be a time to do some sort of cash out refinance strategy. I've talked about this with a few people. They're like, man, dude, I've got 100, 150 grand in equity in my property. I need to get to it, so I'm going to sell it. It's like, well, have you thought about cash out refinance? Now, interest rates are a little different, so you have to do the math, but all that money is tax-free in a cash out refinance. Talk to your accountant and lender, but I can tell you that for 100% certainty before you do a strategy. But I can tell you with absolute certainty that a cash out refinance is not income tax. It's not taxable. So especially if you're in a higher bracket and you have some equity you can take out, you can use that. The other thing that does is it might reduce your cash flow a little bit, or it will reduce your cash flow, but you'll have brought out 50, 75, maybe 100 grand. And that's, how long does it take you to make that back at $200 or $300 or $400 a month in cash flow? It's a long time. So you can kind of weather this, I say weather the storm, but grab that value and then let rents build up over time and get back to that $200, $300, $400 a month and get a good return on equity. One little side note, if you guys do not know what return on equity is and the difference between return on investment and return on equity, please watch that video. I've done it many years ago on a whiteboard, and I will walk through the difference. Return on equity is return on the equity in your property, and return on investment is the return on what you used cash out of your pocket to buy the property. So over time, your equity should go up as you pay down the debt and the value of the home goes up. So, and if you're making the same amount of cash flow, then your return on equity is going down. So watch that video, that'll explain. I don't have time to talk about it here, it'll be a very long video. So that's the first thing. Make sure y'all are paying attention to what your equity is and if this property still makes sense as a rental property. If you want to take some money out, if you want to sell it outright. I mean, a lot of property managers will not tell you that, oh, don't sell, you're going to lose a property. But to be honest with you guys, sometimes it makes sense. Take that money, do something else with it. I personally would cash out refinance if I had a lot of these properties and I wanted to deploy it into something else. But, because you're still want to hold that asset, that great asset, and especially in an inflationary time, hard assets are a great inflation hedge. So that's one thing. The second thing is we've seen an increase in accidental landlords. And what does that mean? Oh, hey, I've inherited a property from somebody that's passed away, or, oh man, I'm getting relocated and I don't want to sell my property because I have a 2 or 3% mortgage. So I'd rather just rent it out. I don't want to give up my 2 or 3 mortgage. Maybe I'll come back, maybe I won't, but I'm going to keep that property. And so that has created a lot of inventory. Especially, again, I'm going to talk locally. I'm not sure about every other market. I can, surmise that most of the other markets or general markets are going to have this, but a lot of people want to hold on to that 2-3% mortgage that they've had, especially for a primary. I've got investment properties at 3.25%. And yeah, it's going to sting for me to want to do a cash out refinance or something and get 5-6% interest on that new loan. So I'm holding on to that investment. So you're seeing people buy another house to maybe live in, or maybe it is a rental, but they're keeping this one that they normally wouldn't. Maybe they would sell it and do something else with it. So there's a lot of first time and accidental landlords is what we call them. So those folks are now listing their property for lease. They're renting it. They want some sort of return while they decide what to do. And we've had several of those clients come on board over the past few months. So I can tell you from experience that is happening here in Greater Houston. So what does that mean for everybody who's existing with all their properties, and why am I telling you this? So I did the video, again, look at that about rents and what we're doing on the strategy, but it's creating more rentals. And anytime supply goes up with the same amount of demand, the price will fall. So demand has to go up with supply. Now, because prices have gone up so much and now interest rates are going up, it has pushed a lot of people out of the market. So people that were thinking about buying are now staying in place. They're saying, hey, Cameron, we want to renew. We're not going to move. But new properties that are coming online, especially those expensive properties, or at least in our market, $2,000, $3,000, $4,000 a month, we're seeing those sit a little bit longer. Instead of, the $1,500 are still selling pretty well, but those $2,000, $3,000, $4,000 a month, there's so much inventory, so many options that we're seeing that competition stiffen up. So just be cognizant. The main reason that I want to tell you this is be cognizant with your numbers. If you guys are buying a new property, or you're thinking, man, I'm going to go buy another property, I'm going to rent out my current home, make sure you're being conservative with your numbers. When you're looking back 180 days to do comps and run CMAs, comparative market analysis, to determine what you want to lease the property for today, it's not going to work. I can tell you with absolute certainty, because we've done it, it's not going to work. The prices and how quickly stuff was leasing back in March, April, May of this year, when interest rates were still 2 and 3%, maybe 4, is totally different than August, September, October, November, whenever you watch this, and the mortgage interest rate just crossed 6%, which it hasn't done since 2008. So totally different environment. Do not think that you're going to get the same interest rate or the same rental rate in March or April as you are now. So be cognizant with that. So that's the second takeaway. Number one, look at the equity in your property. These prices have gone up substantially. If you currently own a property, you've probably seen that. You can reach out to me. I'll gladly run a CMA for you and see what the property's worth and see if that's some strategy you want to help with. I look at myself as a partner for you and what you want to do with your wealth strategy and how real estate fits into that. But the second thing is, when you continuing to add to your portfolio, and a lot of the really good real estate investors that I know continue to add through good times and bad times. I've talked about this a lot. You dollar cost average. So you buy when the market's at the top, you buy when the market's at the bottom, you buy when the market's at the top, and over time you're going up. It's going down, up, but it's always going up and to the right. So just be a little more conservative with your numbers. If a tenant's currently paying whatever $1,500 a month and you go to renew, just don't expect that 7, 8, 9, maybe 10% increase that we've seen, in 2020 and 2021. If a realtor is pulling comps for you and they're not a lease agent, they're not a property management company that's going to manage the property, be a little bit more conservative with their number. If they're telling you it's going to lease at 2,000, maybe run your numbers at 1,900. Just be a little more conservative, because if prices continue to come down, if supply is continuing to rise and that demand is staying the same or not keeping up, then prices have to come down. So I hope that was helpful. Guys, I'm really telling you this to help you out as you go forward with your current portfolio and as you look to buy more property. So please be cognizant of that. Watch out. It's a changing market. Now it's changing very quickly. We had that nice steady climb for a while. Things are changing, so you've got to be firm. Hopefully you have a lot of equity, which can cushion you, and a lot of cash flow to cushion you. So if you guys enjoyed this, share it, please. It'll help me out quite a bit. I appreciate that. If you've got any questions, comments, concerns, you can comment below or shoot me an email, text, phone call, whatever you need. See you all next week. Thanks.